check this out. When our next guest joined us last on October 4th, he gave us 4 stock picks. Each of them have outperformed the S&P 500, which is why we invited him back. And you thought gift-giving season was over. Director of Research and Strategy at Sanibel Captiva Trust Co, Pat Dorsey, is in Chicago with his most recent picks. Good to see you, Pat, and congrats on outperforming the S&P 500. We want to start with some of your new favorite picks. Kinder Morgan, why?
So this is Kinder Morgan Inc., ticker is KMI. It's the holding company that owns the general partner of a huge pipeline and terminal network, about 37,000 miles of pipelines. Pipelines, oil and gas pipelines, are very attractive economically because the volume doesn't vary much as commodity prices, so it's toll bridge-like assets. Yields about 4% right now. But the kicker is that they just bought El Paso recently, which is going to really increase that distribution. So you've got about a 4% yield, and that yield is going to grow at about 10 to 14% over the next few years, which is a very attractive total return.
Yeah, I remember that deal. It was a huge deal in the energy space. You also are looking at the CME Group. This is a stock that's been hit hard, down more than 20% so far this year. You like it?
I do. I mean, futures exchanges are much more attractive than equity exchanges because if you open a futures contract on, say, the CME, you have to close it there. It's not a fungible asset the way, say, a stock or a bond is. And that enables the CME to generate 60% operating margins. They're a phenomenally profitable business. And volume of derivatives contracts, futures contracts, tends to vary with volatility in the market, not so much with the market being bullish or bearish. And I don't know about you, but I'm certainly expecting plenty more volatility in 2012. And for a business with 60% operating margins, monopoly-like margins, I would say, trading at 12 times earnings, I think the CME is a pretty good bet.
All right, volatility in 2012. You also like Express Scripts, moving on into the healthcare space.
Yeah, so Express Scripts is what's called a pharmacy benefit manager. Basically, they are a bulk buyer of drugs and then distribute them out. Yeah, they are engaged in a very public spat with Walgreens right now. And I think the fact that they've gained the upper hand in this spat really shows how the balance of power has shifted in healthcare. You know, it used to be you'd walk into the pharmacy and get your drugs, and really the way drugs are being distributed has changed. You're getting them mail order more and more often, and that gives the advantage to companies like Express Scripts, which really benefit from the cost containment trend that's happening right now, because although the volume of healthcare is likely to go up from Obamacare and the aging of the population, you know, cost control is a huge issue, but Express Scripts actually makes more money, better margin, off generics than they do off branded drugs. So, you know, Lipitor goes off patent, they make more money. It's a huge tailwind for them, and at 12 times earnings for a business growing about 18%, I think it's a pretty good deal.
We've got another one in the energy industry. NOV is the ticker symbol, and this one is one of your oldies. You say it's still a goodie.
It is. It's up about 30% since we talked about it last, but it's still a very good business. It's called National Oilwell Varco, and they're really the dominant supplier of rig equipment. So if it's an ultra-deep water rig, a gas rig drilling for shale gas here in the U.S., the odds are very, very high, that about 60%, that it's going to have National Oilwell Varco equipment on it. And as the oil and gas extraction, especially with shale gas, becomes more mechanized, because with shale gas, the geologic risk is very low. You know where the shale is. So it's almost like a factory getting it out of the ground. That increased mechanization of gas extraction really benefits the volumes of their products going into the market. They're so dominant, in fact, that many of their customers call NOV no other vendor. And that's an indication of just how dominant they are in their marketplace. Shares trade at about an 8% cash return right now, and their dominant position in the marketplace really means that as long as the demand for energy continues to go up, and energy is harder and harder to find, such as the ultra-deep water drilling off the coast of Brazil, demand for their products goes up, and that keeps their margins high.
All right, Pat, time to go out on a limb. Which stock is that one?
Well, I'm sure no one's a big fan of Larry Ellison right now after the 14% drop in one day in Oracle shares recently. But I think and we think at Sanibel Captiva, that the drop was really overdone. You know, it was an issue of demand, really slowdown in purchases by large IT managers. It's not an issue of competition, because really once an organization has an Oracle database installed, they never ever take it out because it's so difficult to disentangle from all their other software. That enables Oracle to have very high operating margins, returns, a very strong competitive advantage. And right now, they generate about $12.6 billion in free cash flow off a $115 billion enterprise value. That's an 11% free cash yield, which I think is tremendously cheap. So at 25 bucks, I think you've got a lot of upside in the stock.
What about all the acquisition talk? Hasn't that been priced in?
The acquisition talk? Well, the nice thing is that, at that an 11% cash yield, I think that even if they don't do any deals, you're not going to be too concerned. The risk of an overpriced acquisition is there. I mean, Larry Ellison is not exactly a cheapskate when it comes to doing deals. But the core database business is growing at about 5-6% a year. So even if they become almost utility-like, you're going to do fairly well at the current price. It would actually be nice to see them return more cash to shareholders. But with Macho Man Larry Ellison at the helm, I'm not holding my breath for that.
All right, he's going out on a limb with Oracle. Special thanks to Pat Dorsey, Sanibel Captiva Trust Company Director of Research and Strategy, for his 2012 stock picks.